Thank you, Samir, for being with us, and congratulations on getting your mutual fund license.
Thank you very much.
I'm starting on the questions right away. How it all started? After your education, did you plan to be a money manager, getting into investment management or anything, or you did something before?
I had no plans. Actually, I was studying at Wharton School and I was doing a PhD in finance. So it meant that broadly I'll be in the financial field. But I applied for a few jobs, and if I got shortlisted by McKinsey and even Alliance Capital. So if I had got a job at McKinsey, maybe I would have just taken that and been very happy that I become a consultant. But I got a job with Alliance Capital, which was a mutual fund company in the US, which still is a big mutual fund company.
Alliance Bernstein.
Now it's called Alliance Bernstein. That time it used to be called Alliance Capital. And in the end, it was because they were interested in India that I landed up in India. Otherwise, I had studied this extra 2.5 years at Wharton, basically to work in the US. But then when India opened up and they were interested, and I took the bet, which you can say is my side of the decision making, that I took the bet that I would rather come back to India instead of continuing at Alliance in US or in New York. So after that only I have discovered my true love for investing.
Okay.
And now I plan to never retire.
Achha, you don't plan to retire ever?
I wish that I can be like Mr.
Was there anyone who was inspiration for you while you were there as working
so actually
there?
What has happened is when I joined Alliance, and so I got 2 years of training as an analyst, you can say. I mean, I was working, so it's not training, but and then when I came to India, then it was in 93. So I was very early in the business. And for 2 years or 1.5 years, we didn't get any approval because it takes that much to get mutual fund approvals. And during that time, I met all the Indian fund managers and traders and companies, and I read books because I was nervous that one day when I get money, I have not been a fund manager for a day, and I have not even been an analyst for a day for India. But in that 1.5 years, I became, like you can say, self-motivated Indian analyst because Alliance was too far away, and even they had nobody else who had done anything in India. So during that time, everybody
became... They were not a FII here?
No, they were an FII, but I was the fund manager.
You were the FII.
So there was nobody there
Okay.
Separately who you can ask. You can ask general questions on what research is, but it's not that you can ask them anything about what to do in Indian context. So then everybody became my hero in the sense that whatever books were there, mostly they were in the beginning only related to Warren Buffett.
Okay.
Because that time he was the most famous fund manager. So in some sense, everybody's hero initially is Warren Buffett. Okay. Then you say, oh, no, I know this thing little better, and therefore it is Soros and everything. But if I were to say, because I didn't really meet any of these guys it was all books. So I say books are my biggest heroes because I read every hero's book.
Okay.
And then I choose to be influenced by a few, and some I object to now.
Paint some picture for me in terms of you started your Alliance Capital, Alliance 95. And what was a complete surprise to you? The way, was dematerialization came into being by that time, or was something?
No. I don't think it came at that time. I would think it came between 96 and...
So you're getting physical delivery?
Physical delivery. I forget the exact days. But I know that for many stocks that I sold, particularly even before Alliance 95, I was an FII.
Okay.
And so our fund was called India Liberalization Fund.
Yeah.
And that time I remember that I wanted to sell Reliance Industries, and there were no Reliance Industries shares with us in the sense that they had gone for transfer to us. And the broker used to say, don't worry, we will go to the transfer agent or registrar and get them quickly. And actually that was the strength of some of the brokers. Not that they know any research, but that they will quickly arrange your shares to come back.
Okay.
Because these guys would hold the shares for various companies. And the other thing that many of these brokers offered was that we will be able to tell you live prices from the exchange.
Yeah.
That is it. And one of them suggested that there be a box put in my room. So I could hear the prices from the...
Okay, they will go with a walkie-talkie or a wireless.
I don't know how exactly, but they were going to put a box. But before that, then the PTI screen used to be there.
The open outcry, and they will be...
The prices would just roll and you wait like a ticker.
Okay.
So the whole screen you would buy, or that box you would buy, only to see a rolling prices. And then, of course, every evening one of the brokers, his main strength was that he would send bhav copy to everybody. I mean,
Okay.
this was the value added.
This was a great
This
research
was
on
great
you.
research that by 6 o'clock or 6:30 before you leave office, like you've got a bhav copy which actually cost 2 rupees and you could have got it yourself. But basically, this was the research. So yeah, life has changed a lot.
So, getting on to your explorations and investment ideas, how do you define a great business? Because now it is your 30-year experience.
So I define two kinds of businesses. One is a great business now, but you're not making money by buying great businesses. You're making money or returns by buying a business which in the beginning you did not know was exactly great or not.
Okay.
Because if you already know it is great, that means it has done well for the last 10, 15, whatever, 5 years. And then that much of the returns are lost, which you would have got from discovering. So, for example, if many people say today that if you buy good companies and hold them for the long term, you'll make a lot of money. But let us say, how did I know in 2001 or 2 that Kotak will be a great bank, or that in 95
It was not even a bank.
it's not even a bank, you're a broker, or in 95 that HDFC Bank would be a good
Great
bank,
bank.
and not only that, that Aditya Puri would be a big hero.
Great
Or
manager.
we also bought Bajaj Finance in 2011. I don't think Rajiv Jain would have known that he's a great.
Mm-hmm.
So we no longer do like that.
Okay.
We say that we have these 8 factors which we call history, theme, management quality, whatever we know about them, and valuations and financials and disruption potential. But first level, we want that it be not bad on any of these 8 factors. The idea is not that you know in 95, for example, that Aditya Puri is a good manager. But there is nothing in his background which would call him bad. There is no bad history. Anyway, there's very limited history. But you're educated, you've worked in a bank, you worked in a foreign bank, you have options, you have skin in the game. So for now, that part is not bad.
Mm-hmm.
But the good part might be that
But there could also be an environmental tailwind.
that's what I'm saying. So that is on other factors. So that would be on the theme part or the industry that it is good, sometimes company policy or competitive position. But the management we don't know.
Mm-hmm.
In many other cases, for example, let's say somebody has to consider buying Indian hotels after demon.
Okay.
Now, if we say we buy good businesses, good companies with generally good performance, the hotel is right now closed,
Mm-hmm.
and we don't know whether there will be a vaccine. So how will you buy it? So we say results are not bad considering the circumstances, and other things are good. Competitive position is good. There is less potential for disruption in this because people will still go to hotels. That maybe the Tatas have an advantage over others. That some other hotels might be in bigger trouble or smaller hotels. Whatever. The point is, no longer do we say that everything has to be good in calling a business or a stock. We want it to be not bad on any of these factors and then good on many factors. But in general, I've also learned that I don't want to say what is a good business for 10 years and 20 years. I want to say what is a good business for the next 1, 3, 5 years. Because even the best of businesses have been disrupted or hurt. They need not be disrupted as to completely go away.
Mm-hmm.
But for example, let's say in the US, you say that we should buy breakfast cereal business because what else will Americans do? They will all their life eat cornflakes. There are 3 cornflake companies, so they have moat. People are not going to change their.
At Kellogg. So
And then somebody says that cornflakes have a lot of sugar, and therefore it is not healthy. Half the Americans don't eat cornflakes. So the thing is, nothing is.
everything changes.
Everything changes. And the ability to analyze a business or the current management or the current policies or the current competition is 1 to 3 years. And then you do it in multiples of that. You don't straight away buy a stock for 20 years, which means you don't straight away commit that this business is good for 20 years. There have been these books, Good to Great and Built to Last.
Jim
written by
Collinson.
And you should see the stocks that they found after doing research of that level, which fund managers
Won't do.
because they would have access.
And they don't exist anymore.
Those companies don't exist anymore.
New core and
Yeah. That's
before getting on to this question, something which was crossing my mind. HDFC turned out to be a good bank, but nobody knew about it when it was at that point. Did you also buy Global Trust Bank, Bank of
That's what I'm
Punjab,
saying.
Centurion?
Yes.
Because there are 5 more. Thanks
Yes.
Bank.
And we bought
So,
at least 2 of them.
Acha.
So because the thing is, we were buying a theme, that the theme is that private sector will eat the lunch of the public sector. And how did I think of that? One is, I could see in the Alliance case when we came in, there were these 4 or 5 or whatever number of states.
8 of them.
8 of them, okay.
No, we
Eight of-
specialize in that.
So 8 public sector mutual fund companies, and instead of privatizing them, you allowed some 20 of private guys to come in. And at that time, we were not sure how much we'll do in performance in terms of beating the index. In the end, it was like some 30% per annum I did. But at that time, we said, if we make a better letter, if our customer response is faster, if we disclose the stocks, if we write a good explanation,
Send account statement.
Send account statement, and you beat them by 0.5%, or even if you don't, but everything else on service is good, you will get some market share. So the point was, you do a little bit better,
and you do well.
and you get to better. So it was the same thing with private sector banks. That private sector banks, the office might be more organized, that they might be willing to come home to take some document which is missing, or they won't send you away saying that you need a photograph. They might have a camera there to take your photograph. So these were the concepts on the basis of which we bought Z versus Doordarshan and Bharti versus this thing, and banks. So in the banks, we definitely had GTB for some time.
Okay.
And I think we had Times Bank for some time.
Okay.
So the thing is that because when you're buying them in the beginning, and we buy a lot of stocks, like 30, 35 stocks, so these are all 2-3%. On day one, I didn't have 7% in HDFC Bank.
Okay.
I must have had 2% or maybe even 1.75%. So 1 or 2 of them underperform for say 1 year, 2 years, and then you leave them because you discover whatever is going wrong. But it's never the case that I only bought 1 bank and 1 NBFC and never ever has it
you're not
happened.
riding one.
In fact, you recently may have seen Prashant Jain's letter. So Prashant Jain says in his letter that in the last 20 years, he bought 466 stocks. Let us say he bought 20 stocks, 50, 60 stocks on day one to make the portfolio. That means he bought 400 stocks in 19 years. And then a few of them emerged. So if you see Rakesh Jhunjhunwala's portfolio, and he made money in basically, say, I don't know, but let's say visibly 7-8 names, but he would have bought at least 100 odd stocks, or maybe even more. So it's the same thing that when you're buying 20, or we buy like what we say 20 new names and 10, 15 established names. In the new names, if you get 5, 6 of them really right, and they go up multifold over time, and the rest sort of, at least relative to market break even, and on a few you lose, that is the formula. You're not going to get that I bought HDFC Bank and never bought any other bank.
Bought 5 and actually bet it big.
No,
and
nobody does it.
Nobody does it. Now tell me something about, which will be guidance for, or, which will be an inspiration for other people. How do you start your day as an investment manager? You do the screening, you do some validation, you do some...
So right now, because we have done it for too long, we have made some things that we like. As I said about these 8 factors, that we want to see the theme, we want to see the industry, we want to see potential for disruption, we want to see history, and we want to see financials, and then we want to see valuation and results. But in all of them, the first thing is to say that it is not bad, not that it is good. So I'll explain. Let us say we are analyzing Asian Paints or some. Asian Paints used to be trading, say, in the olden days, which is say before 14, 15, maybe 35 times. Now, if you say today is 38 times, is it good or bad? We don't know. It all looks the same. You make it 70 times, we say bad.
Yeah.
So first we are removing the bad from everything. And then we are from the stocks that cannot be...
So bad could be on valuation either.
It could be on one line. On 8 factors, any factor. So previously, and even now many people do it, that they would weight these factors. Weight in the sense they'll say, for quality of company, whatever way you define it, ROE, ROC, some cash flow, we give X weight. And for valuation, we give Y weight, which means if it is a good company, you are allowed to give extremely disproportionate valuation. We now don't use that. We say any one factor and out. Because we have understood that still many companies are there which you cannot reject on any of these 8 factors.
But one thing could be damning enough.
And then you look for good things.
Okay.
So one thing may not be damning once in a while. But if you talk about 20 companies that have very high valuation, then 15 will not do well. That we have seen in our life. But what will happen? Some stock will still do well.
Still do well.
Sad luck for us if
That's fine.
yeah, that's how life is.
Any screening? How do you arrive at these companies?
No, so first thing is we have 400 odd companies which are in
That's
the
your universe.
because that is current universe, because we made a thumb rule that we are looking in the last 15 years at whatever is $1 billion. So a few years ago it was 300, but Mota Mati is 400 odd companies. And then we have our first screen is the theme.
Okay.
So we have three favorite themes. We like financials, which we call as competing with government companies. The second theme we like is middle class consumer. And the third theme we like is IT, pharma, specialty chemical, which we are calling factor cost advantage. Okay. So that means by definition, we are not liking some other themes like public sector. We are not liking what we call billion consumer stories. We don't like commodities, and we don't like companies that are basically not Indian companies but just owned by Indians, like Tata Motor, which we call bet on India, not on Indians. Now, in the second group, over time, we realize that you don't want to completely reject a company because of just the theme. But if it is from these four, it has a higher hurdle. So, for example, if you say simply, so we automatically, without analysis, just out of the system, anything other than 2-3 steel companies, anything other than 2 PSU banks in the banks.
Yeah. Okay.
Okay. And we don't want the sixth PSU bank and the same. If we want, we'll buy State Bank or Bank of Baroda.
Now we are not left with too many PSU
Yeah,
banks
there were
anyway.
5-6.
Yeah.
So I'm saying you just want to remove. Steel, we just want to cover Tata Steel and JSW Steel. We are not interested. If there's a third, if you want to buy steel, which normally we don't want to buy because not in our theme. But if we have to buy and it is just a macro call on steel,
at that any
then
point.
we will choose one of these. Otherwise, we are not interested. So that was one. Second is these days industry is a screener for us.
Okay.
Which means 99% of the time, I am not interested in infrastructure sector. Where infrastructure, we don't mean cement and steel. We mean the actual developer, you can call it, the guy who's building the road. We don't want any. It doesn't matter whether you're good or bad. We just don't want you because we don't like the industry because you don't get paid on time. And if you get paid on time, then next time you won't get paid on time.
Okay.
Because, and if you buy
also the nature of the business, is there a possibility that people steal the money?
But it's the same thing. No, in the first day, no, first is working capital.
Okay.
We don't have to go beyond it. The good thing about rejecting is you don't need a second factor. You rejected him on the first factor.
On the first one.
So you don't have to bother about it. So now we won't buy two-wheeler because it is disrupted by EV and we don't know whose EV will succeed. Whether it's your own EV or somebody else's EV or the Ola's EV or the Chinese fellow's EV. And it is all a sort of a zero-sum game in the sense that whatever is the current market has to move to EV. So you all are fighting the current players, and there are 5-6 new guys who were previously not interested in two-wheeler, but as soon as it became an EV two-wheeler, now they also have come in.
And the business has become easy.
And exactly, you can import also. And basically, previously there were 2-3 players, now there are 5-6 players. But nobody is saying that if there is an EV two-wheeler, the market for two-wheelers has gone up. It's a substitution.
It's a substitution.
So वो 2 थे अब 6 हो गए.
An easy business in the sense that the internal combustion engine was 100 components. Now it is 20 components.
Easier to assemble. And it has attracted people who were previously not interested in it. So randomly the number of competitors.
Yeah, the Ola fellow making scooters. So
वहाँ पे जैसे वो आ गया, Tesla आ गया, who was not there. So when new guys are there and the old guys have to invest to shift, nobody knows whose EV will be successful. Somebody's will be successful in the end. So all that we remove for disruption. So whatever. So screens are for us like this.
Okay.
Because we are willing,
on the universe and on a macro basis, you are eliminating industries
industries. We are eliminating managements. We are for whatever history we know of them.
Without revealing a name, tell me an example of a management.
We names also. Okay. For example, we reject Vedanta.
Okay.
We just reject for history. It's not, sometimes the stock does well. It doesn't bother us because there are so many stocks that do well. That if you reject a few, we reject a few for accounting where it's visible. There have been reports written, but they are in the large companies.
Cash flow and profits don't match.
Basically, what happens is the profits that they show in the P&L don't match the shareholder this thing in the balance sheet. Everything is taken to the balance sheet. So आपको profit दिखाएंगे, but अगर आप last year and this year का difference in shareholder reserves वो देखो, that number is not there. Number is not there. There are many companies where the increase in shareholder wealth over the last 10 years would be less than the amount of money they have raised in QIPs or rights issue or whatever. And every year it has appeared that you've been profitable. But even the new money you raised, which should have just added to the
Added to
reserves.
your book
reserves
value.
हाँ, वो भी नहीं आता.
Book value and profits don't add up. The trans.
बहुत, I mean, not many, but there are 20 companies you can reject like that.
Tell me now about your mistakes. You know,
Every mistake has been made.
Every mistake has been made. Okay.
So we say ki, when you say that learn from your mistake, investors in our fund have an advantage. They learn from the mistake we made for others. The guys over there.
Okay, they don't have to bear the brunt.
They don't have to, because we have learned,
Okay.
even if that new fellow is there. So if I say big picture, biggest loss, infra.
Infra.
Because in infra, it was
What made you buy into the story?
in 2005, 6, 7, that was the story that India is doing well, and you're buying road guys, and you're buying JPA, and you're buying GMR, and all these guys. And then 2008 did it. But in most of the cases, even then I didn't give up so easily. But then you realize that in some cases, even if you win arbitrations, even though visibly it looks like some of these things are not their fault, some are their fault. You didn't get gas. How was that GMR's fault, for example, at that time? So we realize that wherever there is too much of, either approval, arbitration. Suppose somebody says today,
Regulations, financing.
if somebody says today that this fellow is about to win in arbitration, we see the odds, we say not interested. You tell me somebody's got a railway order, we say we are not interested. You get a road order, a water treatment order, don't tell us all these things, because these guys don't get paid on time. The other mistakes have been made. I lost 100% in Amitabh Bachchan Corporation Limited, which was unlisted.
Very
Now
early
I don't
days,
buy
yeah.
unlisted. So the thing is, but
Did you also buy Business Standard Limited?
Yes, Business Standard Limited. But the thing is that in the Alliance days, I bought 4 or 5 unlisted companies,
including NDTV.
NDTV. I made GVK, where I made a lot of money. So there it was that, initially when a fund is there, it says you can buy 10% unlisted. Normally they put it in the prospectus. And I bought maybe 4% in 1% in 3-4 companies. So usme basically you don't make anything. So that also is a lesson that I'm not interested now in these unlisted, about to be listed, pre-IPO. Even though now also we have this rule that you can theoretically buy. We have not
Up
bought
to 5%, yes.
I think in our offshore fund we put 10.
Okay.
But in 2008 or from 2005 till today, not even one share we have bought. Yeah.
No, the current regulations do permit 5% in open-end
mutual fund, you mean?
Mutual fund, and 10% in closed-end fund.
I'm talking about my FPI fund, yeah.
So what do you do to avoid these big mistakes in the future? Because now the new problems will be different kind. It won't be ABCL kind of thing.
No, the first thing is that these 8 factors cover most of the potential problems. Our idea is that if now a stock disappoints, it should not disappoint because we know that it had high valuation to begin with, or extremely high. We also have some high. Or that everybody knew it had bad history, but it looked a bit cheap. Or it had, it was being disrupted. Why did we poke our head into it? So it should be a genuinely new surprise. Then it's okay. It's like saying, today if you look at any underperforming stock, any stock, and somebody says, okay, explain why this stock has done badly. According to us, you will use one of our 8 factors.
Okay.
So if those factors, you can say now, you could have anticipated these factors 1 year ago. Now, somebody will buy a bad company because it is cheap, or even an expensive company because it is good. Because they have a view that very few companies are available which are not cheap. I mean, which are not bad. Means they will say if it's a good company, it has to be expensive, and if it is this, it has to be this. Therefore, this is as good a trade as any. But if you see actual stats, we find at least 100 companies which you will say not bad on any of these 8 factors. doesn't have bad history, doesn't have bad management, doesn't have bad valuation, doesn't have bad governance, then you choose 30, 40 from them.
Okay.
That is
That
why,
becomes your subset of the
and
investable
that is why
universe.
our track record is a bit different from everybody. From 2005 to now in my new Helios life, nearly every year we've been shortlisted for the best India fund. We don't win it every time, but we are always shortlisted other than 2 years. And out of 17
What's the
years.
difference between winning and shortlisting?
Means
Performance.
you're in the top 4-5.
Okay.
Then they
No,
will
no,
choose
but
one.
was it performance only?
Performance for that time.
1 year performance.
Yeah. Because you're getting an award for that year. But the thing is, if you're always somewhere at the top, the churn at the top is very high. So nobody's been shortlisted more times and nobody has won it more times. But you don't win every time you are shortlisted, because some year some mid-cap fellow is winning. Sometimes some guy who's overweight on commodities might be winning. This year maybe the energy guy might win.
Somebody been able to ride the trend
No,
well.
this year the energy guy might win. We had more of whatever energy stock. So somebody might be different. But if you're somewhere around these 4, 5, well, that fellow's going after 1 year. And then some financial guy is going to...
And he succeeded in guessing.
And he'll get it for that year or 2 years.
Once you buy into some of these things and you get it right, or it is among, and then it goes horribly wrong, how do you reconcile? Admitting a mistake, or do you do it in a huff, or the way you were saying that the infrastructure story, it took much longer for you to reconcile?
Now I am so shameless beyond limit. Okay. I can go from long to short effectively with one trade.
Okay.
With one trade. I have gone long, which I had held for maybe 10 years, to zero, and by evening short. Because then I say, the short, my long. Why am I happy just selling my long? So, right or wrong is not the first step. I think I can do it. Doesn't mean that I got the second part right or not. Okay.
It wasn't so long. Since when has there been this change? That you can do it like actually, morning to evening?
So even in the Alliance days, I could do it. I was in Calcutta and they were asking me about some stock, which it had come in the paper maybe a month or 2 months ago that I had bought. And then some accounting issue we had discovered. So I had sold it. So this guy said, you had bought that stock. I said, let me tell you, we buy our stocks with the highest confidence and conviction. And we sell them with even more conviction and confidence. So the point is, if you are detecting a mistake after buying, there's no point in saying, oh, what will the public think that you bought it last month? The public will be okay. I mean, the investor will be okay if I'm right. Not that, oh, I refuse to sell because the image will be that I traded. That is the game. The game is that you are not getting everything right.
Okay.
You are only, the strike rate is only 30-40% or 20%. You are trying 20 to get 5 or 6 right, and the rest should break even relative to market, plus minus, so that these 6 give you the alpha.
Tell me your opposite of this, that you thought that something has gone wrong, it's a big mistake, and it turned out to be very right, it was a great thing, and you actually got it all wrong.
Well, I didn't buy.
You sold it or you didn't buy in the first place?
So that in some sense you can say for all these 3 or 5 consumer companies that have done well, because in a proper sense, where we have enjoyed all the gains in the tech companies or in banks or in a few consumer companies, but we haven't made anywhere near what the market has made in Asian Paints and Pidilite and all these 2-3 stocks. Because they always look to me a bit expensive, even in the last 5 years.
On the valuation front, they flip.
And even though in the olden days I used to own some 2%, but these companies you could have had 5% because they were in our first group of stocks. But they have continued to go beyond limit, according to me, in terms of valuation. So now anyway, I don't buy them. But there have been many stocks like that. Because this will only come in stocks that ultimately prove to be big winners. So separately, let me tell you, nearly every multi-bagger other than specialty chemicals I've had in my portfolio.
Okay.
So mostly we have also got them. But if you say which are the ones we haven't got, will be the ones which otherwise have been very big winners also. And it would be mostly from this sector. Because banks we had mostly got right, and IT we were early and mostly got it right.
When do you sell? And we have talked so much about how to buy, what not to buy.
We have 2 kinds of stocks in our portfolio. One is what we call high confidence in reasonable return. So these are stocks where everybody now knows they are good. Okay, so it's not that I only know. So in these stocks, I am choosing them rather than discovering them. In today's context, there could be stocks like HDFC Bank, or nowadays even ICICI Bank, or maybe some TCS or Bharti or somebody where everybody broadly agrees that
it will do well.
good. So here the idea is that you will not make serious money. You will make little bit more than the market because everybody knows these stocks. So here we hope to make 3-4% more than the market.
Okay.
So here the expectation is that earnings growth be given to us in returns. But if these stocks get re-rated more and more, then I don't like it.
Re-rated
Means
down
अभी और go up कर दिया कि पहले से also they were well known, and they go up 20% in earnings, and the stock goes up 30% or 40% again and again.
Okay.
This has happened many times. So here the idea.
Pidilite and Asian Paints will actually be the case.
That's why I don't like them. So what happens is, it should, for a well-known company, the earnings I should get. I don't expect it to be more re-rated and more re-rated because they were already rated when we started. So now here, if you own it, obviously you'll be happy. So we are happy. But we also know that this is not a sustainable thing. But secondly, because it's a fund or it's a PMS, every day new investors are coming into to invest, let's say. So in theory, you'll have to buy them the same stock because everybody has to get the same thing. So sometimes if you're a personal investor, you may say, let it be. Chalne do jitna chalta hai. And you're not buying new. But as a fund, if our fund is successful, literally you're buying it for the new guy. So therefore we trim and one day sell. And then there is a second group of companies where we were buying those early 2% wale, where I was saying that you buy 15-20 names and some of them will be successful. Those you're buying relatively early, where the discovery part is there. Either the company is new, or it is currently doing badly, or because of COVID it fell or whatever. But there we are buying 2% per name.
Okay.
So there we are either discovering or rediscovering the stock. So वहाँ पे it has to go a little higher than because you bought it in a bad phase or an early phase. So there we are not selling so easily unless the company itself turns out to be a wrong choice.
Okay.
And one more thing, I made a rule more or less that I am not giving it more than 1 year to prove itself after I have bought it.
Okay.
Unless it is in black and white, that company is doing well but the stock is not doing, and I can understand it ki chalo
comprehensively that
chalo theek hai. For example, actually, although I keep saying it, HDFC Bank, our number one holding, is underperformed for 2 years and we haven't sold even one share. But still I say, and I believe that I do, that if it is a company which is not doing well for 1.5 years,
you give up.
I will give up because there are so many companies that do well. That is what I want to keep emphasizing.
Okay, so it's a missed opportunities, the opportunity loss in a way if you don't get rid of it.
Yeah, exactly. Because either there is something beyond, that means you haven't understood it. You can give it 1 year. You're not going to give it 3 years to wait and prove itself.
Okay.
Because whatever thesis you had was not that in 5 years it'll do well.
No, but everything can actually can be fine, but just the stock price for some reason.
So that's what I'm saying, that just in HDFC Bank we have not sold. But I still think that is what I do, and once in a while I do. That I say there are many, because there's always shortage of money. There are always more ideas than money.
Crowded priorities. So
there are so many good stocks.
Good stocks. Okay.
People think that there are very few good stocks. There are too many good stocks according to me.
No, so I have a next question listed, but I think you have already answered it. That just because the stock goes up, you won't sell. The stock goes up and it goes way beyond the value, the earnings. So first then you will sell.
So basically, the thing is that why do you have to sell on day one? Because there's no answer to this question.
When you sell.
So we will sell gradually if in the first group, which was well-established names, the stock has been higher and higher rated for a normal or whatever earnings growth.
Standard growth.
You wanted that earnings growth. Why we have not sold HDFC Bank forever? Because if you see every year, broadly speaking, its earnings used to grow 15, 20% or 25%, and the stock price used to grow 15, 20, 25%. Very easy to handle it.
Ride it, yeah.
If the stock's earnings are growing 15%, and year after year, for 3-4 years, the price goes up 30% per annum, and it was well known before, वो stock 30p का 70p होगा, क्यों भाई? We cannot take it. We will trim it along the way, and maybe in the second year we would have sold.
So you are holding it because you did not trim it early.
You are holding it because you No, you're holding it because you also want to let it go as far as possible because there's no magic. But the magic is that when a new guy comes, will you buy for him? If we say no, we won't buy for him, or we won't buy this amount for him.
5-7%.
Then we say, isko bhi kam karo, so that the new guy can also buy it, and the old guy has taken his profit. But the thing is, people have a feeling that if a stock continues to go up after you've sold it, and it goes up, say, 20% more, like I did for DMart, it went up another 40-50%. So what happened? My market also went up 50%, my NAV went up, say, 50%, that stock also went up 50% extra.
Okay.
So it's not that when I am selling, I'm putting that money in a bank account. I am also buying some other stock. So some other stock will also go plus minus whatever that is. And I will be more comfortable because I will not be holding that high a valuation or that unreasonable a re-rating.
Selling on a fall, when do you get into act?
Selling on a fall depends on if we can justify the fall.
Okay.
Yeah, this is wrong, this is bad, they've done something, and we will also sell. Because we also, because
So
we
messed up.
Because we also short stocks, so these days we are very relaxed about buying, selling on this thing. But if a stock is falling and the analyst or we say, हाँ यार ये तो गलत काम किया है इसने, or whatever, and you are early. So one more thing is, if you have to panic, you panic early, because there is a whole list of different level decision makers in this world. If suppose today there is a issue on some pharma company, mostly we don't own pharma, so let's look at from a shorting side. Let's say there is some problem with the pharma company because some FDA guy has come in and blocked one, and the stock has fallen 10%. Absolutely no problem. You should short it, or if you have the stock, you should sell it, because they'll be that evening some London analyst will write a report. Next day they will give that report to the Fidelity fund manager. 3 days later, the Fidelity fund manager will sell it. The
You'll be looking at that dynamic.
This point thing is, it goes on for months, where for the same news, both buying and selling people are still talking about an event which may have happened 20% away. You have to understand whether the event is serious or not. If it is serious,
tell me some examples of when a company actually loses the plot. What is serious when the company does something wrong?
Oh, many times. Mostly in these financial companies, it went wrong. Like it, I won't tell you now. Again, I bought the stock, but it went wrong in 18-19 because they would all refuse to fully acknowledge the debt of either Reliance Group, that Anil Ambani Group,
Reliance Capital,
or Yes Capital exposure, or DHFL exposure, or Idea ka exposure, and everybody in the market knew. Because
everybody was ostrich. Yeah.
Everybody is broadly knowing that this is doing badly, and if you don't take those hits and you don't either write it off or acknowledge, or you say, nahi, hum hamare aa jayenge because we have this category, we have that category. All those stocks we sold very quickly because we realized that these guys are not either communicating correctly or themselves not.
They'll be caught on the wrong foot.
So ऐसे होते, mostly financials में होता है थोड़ा बहुत. And in other sectors, it is mostly like in financials. Sorry, in consumer, it is mostly to valuation, because the profits don't change; they change 15% only. IT guys, so I'm totally convinced that they don't know anything beyond 15 days. So there's no need to even listen to them. What do you think will be next quarter's orders from US? They have no idea, because their customer has no idea. Because the customer is getting hit by stock price, and nobody knows the stock price. So some of these you don't need to worry. Ki management has said that they have orders, or they can see orders, or they hope they will have orders. In 2000 we saw. Nobody knew a thing.
Yeah.
So some of these things, actually, if you look at it, the biggest loss has been when something bad happens and you talk to the management. They will convince you.
Okay.
There is no need to talk. If you're broadly following the company,
then you
just do
you get a better sense or reasonable sense of it.
No, don't talk to them.
Don't talk to them.
Or whatever, talk to them, but don't believe them too much. We talk to them, somebody will be talking, there'll be some conference call organized, or they'll come on TV, but don't believe a word of all these things. When things are bad, they don't know.
I'll ask this question, and then something is crossing my mind, which is, you have managed an open-end fund, and now you have managed a hedge fund or a PMS account, so to say, or
hedge fund for 17 years.
And when a lot of select group of people invest, and they are well-heeled people who are investing in this. So compared to masses investing, it's almost like a herd. compared to these people.
Correct.
How different it is?
No, it's not different. Actually, the crowd is more intelligent than the institutional guy. Because the institutional guy thinks that he wants an answer for everything.
Okay.
So, actually, because they are themselves responsible to their employer, whoever is the employee who's given us the money from our hedge fund. No, not the PM, I'm talking about the offshore hedge fund.
Offshore hedge.
So, the offshore hedge fund guy, because what happened in 2008, we had a lot of redemptions, everybody had a lot of redemptions. So, in maybe September or October or even maybe August of 2008, our net exposure was very low because we had also short sold and sold. Now, one fellow comes to me from one of these big endowments saying that was the best time to buy. I said, I know, but did you give me money that day? What a ridiculous question. As if it is my fault. The whole world is selling. So then he told me, yeah, actually it's true. We also sold our private equity investments at a discount. Because he's telling me in August, which was the best time to buy, your net was very low. So what kind of a long short fund are you? I said, because all your bloody peers were redeeming from my fund. Then I used to tell them, don't redeem, it'll become okay. And in the end, although for that year it was bad to have been bullish, you make it a 5-year period, that was, it didn't matter. Or people who redeemed in August, September, October were the absolute bottom of the world, of India fund, our fund, but they are the smart guys in theory or the institutional guys. So it doesn't matter like that. Basically, it's an issue of the individual managing that account. It's not the institution. So it's the same as any other individual managing his personal account.
Something, which I wanted to ask while you were answering that mid-90s and now when you look at you, because you're saying that don't believe anything what the management is saying.
No. I didn't say that. I said if something is going bad, obviously this thing will be to explain and you will get into it because you'll get into micro. Some of these things are macro. That's what I mean. For example, the IT slowdown, suppose, which I believe will happen now. There's no point in somebody saying, IT is a very core activity. These US institutions have to invest. These European guys have to invest. According to me, big picture, the Europeans who are maybe 20% or whatever of the market for us, they can do what they want. If their NAVs are falling, if their costs are going up, if they are making losses, everything will slow down. So in that micro, this thing that I got an order, you got an order, according to me, doesn't make so much, because even beyond that, the investors also will want to reduce this exposure, high P exposure, global facing exposure.
No, I was looking for my question.
So I don't say don't listen to management.
Okay.
Otherwise, they'll stop talking to me.
No, I was asking about 90s promoters, what they used to say compared to now. How different it is. I'm just trying to get your impression.
Actually, the real good opportunities were in the 90s, not now. Because now we have been disintermediated or intermediated by P funds.
Okay.
So at that time, I was able to buy Z when its market cap was, I think, 50 million. I bought Kotak Bank, market cap 50 million. And that time, a new company, new means, say 3-4 years in business and then going IPO, is effectively a VC type investment. But at least it has 3-year history. It has got listed, so it has to meet some reporting. There is some scrutiny. Now these new things are being bought by PE. So when you are buying from another financial investor. And so this is tougher. But not just to clarify, it doesn't mean the PE guy is making money. It just means that he is dumping in 10 stocks, he is also losing in 8. So I want to clarify, guys, that please don't dream that PE guy is making more money than us. But he is unnecessarily coming in between us and the promoter, I would say. So it's actually, now the guys are smoother. Who says smoother guys are better? Also, simple, abhi IPO hua hai. So I don't say, today's guys have some professional. They become professional at talking because they have learned from the PE, and so it's all same.
Okay, now some broader macro question about fund management. The whole talk is, active managers are struggling.
Correct.
And indexing is going to make a big inroad into the way people invest. So is it a tough craft?
Yeah. So that is tough because even statistically, let us say all the fund managers together are the market. So by definition, broadly speaking, some half will outperform, half will underperform. But then there is a cost of management fee and all that, say 2% on a 12% return. So now you have to make 14% to beat the index. So that makes that 50% into say 35% who will beat the index. Then if you say 5 years, the same fellow has to beat again and again. That will make it 20%. So basically 20 to 25% people beat the market in a 4-5 year period.
Okay.
So I can only say for 25 years, there's not a single 5 year period in which I have not beaten the market. And about 70% of the years. And overall, so I have done a little good. So the thing is, we say active management is good. We though with our hedge fund, with a long short fund, after charging a performance fee, have beaten nearly every long only fund of India after charging a 15% fee. So we will always say active is good. But the trend is that
And active has been good in your case despite that expense.
expense
Which
everybody
fund?
has. But we have an additional expense of
Additional
performance fee.
expense because
Of
fund
performance
manager
fee.
here
Of
domestic
performance fee.
funds
Yeah.
investors
No.
don't
So I'm
bear
saying
that.
we will always say carry the active manager's flag. But that is true that this is true that only 20-30% beat the market. So what I say is, well, I have to, if a big picture sense say that if you buy an actively managed mutual fund or fund, if the fund does badly, you can curse the fund manager. For that, you have to pay a fee. Because if you buy an ETF and you do badly because it goes bad, not relatively, you have to curse yourself because nobody's selling you an ETF.
Okay.
So it's a fee to blame the fund manager
Price
on
of
a bad day.
blaming.
On a bad day.
Finding
On a
price
bad day.
to
On a bad day, you want to vent out your anger. तो आप किस पे करोगे अगर आपके ETF होगा जी इंडिया के ऊपर तो करोगे नहीं अपने ऊपर करना पड़ेगा.
From a broad perspective, any trend that has caught your fancy?
Trend in terms of the trend which we are also trying to participate in is the domestic guy discovering love for equities and professional fund management and willing to pay for it in some sense and doing SIPs and STPs.
That's a big trend.
It's a big trend.
Yeah.
For which we quickly have tried to get this approval, which we have got now. So that is one big trend. Actually, if you remember all the time before 2016, in AM and all used to write these big reports, I remember. One day the retail investor will come. If the India GDP is at that time, whatever it was, 1.5 billion, then we save 20-30%. Usme financial assets are this much. And if they become this much, it will be this. But it never happened. And then it suddenly happened from demon time it happened, after demon. So that I think is the biggest trend for me because our whole business, we have moved to take advantage.
This trendy thing that is happening, that the idea that profit kabhi baad mein banayenge, matlab, buy now, pay later, and this. How much do you believe all this? Do you think any of these things are up for?
So we bought Zomato.
Okay, you got
last month. It was about 52-53 rupees. But bottom line is that you have to then say that whether this is a genuine business, and secondly, whether now the competitors are over and done with. Because mostly in these businesses, when one business is doing a little better, some 50-100 P funds
go about chasing idea.
50 new startups who are nearly same. So the idea might be good, but with 50 people or 40 people trying to do it, then within their competition, they have to lose for many years. And then one day, maybe one guy will make. So you have to delay your, as a public market thing, to as late as possible.
Okay.
When those 50 guys, may say 40 have disappeared, and then by that time,
there could be some opportunity.
So according to me, Zomato is very difficult for a third guy to come in. Okay. It is not a business where you can start in one city. You have to straight away go for national market share. Whereas if you are selling something online, you can start and you also open your website. You also say, I will give you, the similar stuff, and whoever comes, but it doesn't need you to go and open offices and tie-ups and whatever in 100 places. But who knows? But we bought one, you can say, out of this entire new crop.
Because I remember, last time I met you 10, 12 years back, when you're talking about this bunch of things in InfoEdge. And InfoEdge, even at that point, was, very richly valued.
So InfoEdge has done well because InfoEdge became the vehicle
It's a mutual fund.
Correct, for the startup mutual fund. And then the main business also did
Berkshire
well.
Hathaway for
And then Naukri
the
did
new
well.
generation.
Correct.
Now, beyond investing, in general, on a personal level, apart from investing, what do you think there's, clouds in the sky like Russia West split, China, Taiwan, climate change, and do you worry about these things, or you just listen to
So
it?
China, Taiwan, I don't worry, although it might be worth worrying about. So I'll tell you a story. I only know stories. So in the alliance days, India and Pakistan were about to fight, or they said they were about to fight when Bill Clinton had to intervene. I think it was after the attack on Parliament in December, whatever.
The Parliament attack. Yeah.
So कहते हैं कि जी, so I used to be a mutual fund manager, but I used to sit in Singapore. So they said, what are you doing about, how are you reacting to this India-Pakistan crisis and all? I said, let me tell you that in the entire industry, there is only one fund management company that is totally prepared for any eventuality, because their fund manager does not even sit in India.
Okay.
Who knows? If you had asked me 3 days before Ukraine war, that will there be a Ukraine war? I said, nahi, ye sab cheezein kuch nahi hoti, and who knows how to predict. But once it started, I reacted. So my point is that if you look at 50-year and 100-year history of markets, you will say wars don't matter because even 1939, it was a dot. But if the war has just started, you better react.
Better react.
Then don't say
Be
ki,
the first one to
no,
react.
then don't say ki in 100 years these things don't matter. At that time, for
That time, that's the most material thing.
For many years, it could matter. So if it becomes that stage, we will also react. We are not going to sit and say that wars don't matter. But I don't. Every time it looks a low probability, high impact decision. But who knows when this happens?
This next question.
But by the way, on this, I think it will not happen because the US and the world has effectively, by even whatever you say, Russia has been badly hit. Just because oil has been bought doesn't mean they're not badly hit. And China cannot afford that amount of sanctions in the world what Russia can afford, because China is too integrated. And they don't want that kind of this thing that the billion people are then affected, or 1.4 billion or whatever they have. So I don't think it is that straightforward.
Now the next question, for which you have already answered that you are not good, do you envisage retirement, which you said that you will never retire. But what else do you do to make your life interesting?
No, this makes my life interesting.
Okay.
I like reading, and I like the intellectual thing of stocks, and I like shorting.
So you like shorting?
I like everything.
Benefiting from not liking a stock.
I like everything.
Okay.
I like US market, I like Indian. I like everything to do with investing and books. And books are also mostly about investing. Mostly, or at least corporate type books. They don't have to be literally how to invest kind of things.
So thank you very much for all the insight that you have shared with us. And I could really benefit, and many of our viewers will benefit as well. Thank you.
Thank you.